I started this business because I either love sales or I loved what I do. So many of our presidents love being on the pavers, right? They love the work. Starting a paving company, they did not foresee that I'm going to have to be the accounting department. I'm going to have to be HR. I'm going to have to deal with commercial insurance. We're able to offload all of that back office headache for them. We wire all funds the day of close. So that would all be in their bank account once the wires are cleared. I think the biggest mistake that I see is they try to tackle everything without asking questions, and they experience paralysis by analysis.
Welcome to M&A Talk, the #1 podcast on all things related to mergers and acquisitions. Brought to you by Morgan & Westfield, a nationwide leader in mergers and acquisitions for small to mid-market companies. We bring you exclusive interviews with industry experts in business sales, valuation, private equity, investment banking, and more. It's our mission to provide you with insight and guidance on how to build your company's bottom line and maximize value for eventual sale. Here's your host, Jacob.
This is your host, Jacob Oros, and president of Morgan & Westfield. And if you're considering selling your company, and if you'd like to work directly with me throughout the process, you can schedule a free consultation at morganandwestfield.com. And also, if you'd like a free copy of one of my 2 recent books, The Art of the Exit or Acquired, I'll have those linked in the show notes as well. And if you have any ideas on how to improve the podcast, I'd love to hear your ideas. You can send an email to podcast@morganandwestfield.com. And now on to today's show. We're going to talk about a topic that we've never talked about before, and that's a roll-up. What the heck is a roll-up? And we're going to tell you exactly what it is, how it works, and what's in it for you as a business owner. And just at a very high level here, if you do own a company and you're considering selling it, there is a chance that you could sell it to a private equity firm that is doing a roll-up in the industry or in your industry. And that's what we're going to talk about today. So if you do own a business, this show is going to be very helpful for you. And Brandon, welcome to the show.
Thanks for having me.
So let's start off with a punch. For those that don't know, if you're an entrepreneur, this is important. If you're selling your company, we'll explain later why that's the case. But what's a roll-up in a nutshell?
So in a nutshell, a roll-up is where a private equity investor will go in and find a certain type of business that is largely fragmented in the marketplace and will try to cobble together several of them to create a larger platform entity and then, gain scale through acquisitions.
Got it. Lots of benefits there, multiple expansion for the private equity firm, synergies.
Absolutely.
And so forth. What industry are you in that this is happening now?
So we're in the construction industry, and more specifically, we're in paving. And within paving, we are in the repair and maintenance space. So a lot of our work is focused on parking lots, working with commercial customers to make sure that parking lots are paved, repaired, striped, and patched appropriately.
Now, did you start with the private equity firm, or how did you get into this?
So it was a mix of both. So when I interviewed with the company, I was at a consulting firm. I had done a previous stint in corp dev at a building products company. And I was introduced to the private equity firm. They were looking for someone to come in and build the M&A engine, the corporate development function. So it started with the private equity firm. And then I met the management team that they were building out before I took the position.
Did they build that management team before they did their first platform acquisition?
They did. It's actually really interesting. So we are co-sponsored 50-50 between 2 private equity firms. 2 firms were doing the same roll-up strategy. And the principal of one firm was really good friends with the principal of the other firm. And they said, hey, instead of competing against each other, why don't we complete a merger of the 2? And then once that merger went into effect, they said, hey, instead of the private equity firms running M&A, we need the company to be able to do it itself.
So how big is this industry, by the way?
So the industry itself is approximately 50 billion, and we're about 1 billion top line.
How did they stumble upon the paving industry? Did they do industry research?
They did. So Tom's the CEO and he has done several roll-ups. He was at Masco before they were what they are today. He also did a roll-up in the fire space. And he said that they were sitting around in Jacksonville in the private equity firm's headquarters and went through a laundry list of, the various, markets or industries that they could get into. And there's been a lot of play in industrial, products and services. HVAC roll-ups are very popular. And they didn't see a lot in the paving space. So they were essentially first entrants into this space. And that's why we are as large as we are compared to some of the other private equity roll-ups going on.
How many big ones out there? How many billion plus paving companies out there?
So we are the only company that's private equity backed that's $1 billion in revenue. The next closest, I believe, is in the 300 to 400 million range. I'd say there's 2 or 3 that are at that size. And then we're seeing a lot of movement. Now that we've started making headlines and, our acquisitions are, in the press, you're seeing a lot more small roll-ups start to take place.
How many total paving companies? Tens of thousands?
Yes. And we have 40 just within our own portfolio.
Mm-hmm. Interesting. Okay. So let's take a step back. Why a roll-up for private equity firms? Why that investment strategy?
Well, I think to your point, there's multiple arbitrage, right? We are working in a space that is highly fragmented. We are able to go in and buy multiple companies in parallel due to the processes that we built. And oftentimes we are able to do so at an advantageous multiple for the private equity firm because there hasn't been as much movement in this space. So it's been very interesting to see the multiples when I first started the role. And, we were one of the only players in the space versus now things are starting to creep up.
Other PE firms are getting into the space as well?
Correct.
What kind of changes in multiples have we seen?
It hasn't been drastic. It's not been anything like you see with tech, right? I think that, at the outset, multiples were anywhere from 3.5 to 5 being a very, very well-scaled, well-run business. A lot of automated systems, strong management team in place, and maybe even multiple locations they've been able to greenfield. Now I would say that it shifted probably from that range, 3.5 to 5 to, 4.5 to even 6.5, depending on if another player has gotten into the space and rolled up, 3 or 4 locations.
What size companies are we talking about? What size revenue or EBITDA?
I'm going to give you the most consulting answer ever, and it depends. So we've done deals where the headline purchase price was $115 million, right? But I've also done acquisitions where it was $1 million because we wanted to bolt it on. I'd say what is middle of the fairway for us is something that's anywhere between 30 and call it 75 million top line. And then, EBITDA margins, that 10 to 15% is kind of the bread and butter.
Brandon, let's talk about the EBITDA margin a little bit more if you can.
Yeah, absolutely. So I think for a lot of these businesses, EBITDA is a relatively new term for them. And so, sometimes they are not managing their business as though it is going to be sold. And the EBITDA and the margin may be a little bit lower than we would like. What's interesting in this space, because it is a relatively new industry for private equity, is I can have that conversation with the seller up front and say, look, right now may not be the best time. And I'll be very transparent, say, you're not going to get what you want out of this business based on your current EBITDA profile. But you can improve that over 6, 9, 12 months, come back to me, and we'll make sure that this business is going to make it through the investment committee deck and process that we have set with our private equity sponsors. And you as the seller are also going to get the financial liquidity out of this business that you want from a sale process.
What's multiple expansion for those that don't know? And what are you seeing in terms of the numbers there?
So multiple expansion would be where a private equity firm has bought us for, call it 10x as a platform. And what we are going in and doing is buying bolt-ons at a much lower multiple. So say, 4 to 6 times. And then as we look to go to market ourselves, the returns that the private equity sponsors and investors will get is based on what they purchased us for versus getting these bolt-on deals at a much lower multiple.
What's your end game here?
For us, we probably have another round with a private equity sponsor. I think we can go upstream. I do think that once we eclipse that 2-3 billion in revenue, then the company looks at, okay, here's the fairway, right? Here are the services that we do. We have 10% 50% plus market share in paving, repair, and maintenance. What else can we do? Is that street sweeping, site grading, landscaping for commercial properties? And then you start thinking about how to make acquisitions in those verticals and those adjacencies.
What's in it for a business owner selling to a company like yourself that's doing a roll-up?
Right. Well, there's two paths. For the companies that we acquire where this is a new market and we want that person to be a leader, I think there's a lot of growth opportunities for them within the organization. First and foremost, it's a way to take your chips off the table, right? All that sweat equity that you put into your business is now financial liquidity. You also have the opportunity to roll forward some of your proceeds into our platform. And what that means is a percentage would be a better term, held back and, reinvested as stock into the overall platform. The returns that a seller can get investing in the private markets versus putting that into 401k or just investing in stocks generally are much richer for our types of businesses. So not only are they getting that first bite at the apple when they have the sale, but they're also going to get a second bite. And then if, say, the turn after that is with another private equity firm, they could potentially roll forward more and, the corpus just continues to evolve and grow. So we also allow them to gift bonuses where key employees are able to reinvest in our platform. So it's also a way for them to reward a lot of the key personnel that have been there when things were, look, most of these companies, there was a time and a period where they didn't know if they were going to be able to keep the lights on, right? And so for them to be able to reward those employees with material and significant, investment opportunities on our platform is something that's really rewarding for the sellers.
What are the biggest objections that you hear?
From sellers, I think that there's just a negative connotation with private equity for better or for worse. And obviously not every private equity firm is the same. I'm not trying to.
They've all seen the movies.
Right, exactly. And so I think that once I'm able to get them over the hump there, it's usually the same thing. It's the Hollywood notion of if I'm going to sell, then what I'm going to do is come in with a guillotine and just start chopping heads and, getting rid of people because I'm trying to drive out costs. And our deal strategy is not cost driven. It's solely revenue driven because we are a roll up. And so I need the personal relationships on the ground that they provide. So once they get comfortable that I want them and I want their people, that generally helps alleviate a lot of those concerns.
What are some of the upsides? If that's the biggest objection, what are some of the upsides that you hear people talking about?
In the paving space specifically, and I heard this as well in building products, was I started this business because I either love sales or I loved what I do. So many of our presidents love being on the pavers, right? They love the work. Starting a paving company, they did not foresee that I'm going to have to be the accounting department. I'm going to have to be HR. I'm going to have to deal with commercial insurance. We're able to offload all of that back office headache for them. And in many times there are cost savings for them at the local level because of our scale. And they're able to go out and do what they like. There's been several owners where they've said, I've only got a year left. And that once they didn't have to deal with payroll and insurance and accounting, they said, nope, I love my job. I want to stay on for, as long as you'll have me, which is kind of fun to see.
That's been my experience with owners. Is a lot of them just want to get rid of the stress. They like certain aspects of their business, but they don't like the stress of wearing all those hats.
Well, also the thought of when you're backed by a private equity firm and you want to grow, if you take your personal money and spend that on CapEx and try to greenfield a new location and it doesn't go well, that's your personal nest egg.
Yeah, all your eggs are in one basket. It's very
exactly.
risky.
Whereas we have that financial backing where we can do that and it's not something that's going to come out of their pocket directly.
Well, let's take a quick break. Then when we come back, let's talk about deal structure and what you as a seller should expect if you're selling to a private equity firm that is doing a roll-up, and we'll be right back. This is your host, Jacob, and thank you for listening to the show. If you're interested in selling your business and you'd like to work directly with me, you can go to morganandwestfield.com and you can schedule a free consultation. And like I mentioned, you'll work directly with me throughout the process. And now back to today's show. Welcome back to M&A Talk with Brandon Blewett. So Brandon, let's talk about deal structure. What should they expect about deal structure selling to a PE-backed platform company?
So I think most private equity-backed companies are going to start with wanting to do an asset purchase, just given the liabilities that come with a stock purchase are a little bit riskier, given that some of these businesses, we don't have a lot of documentation and detail. And it's not that we are expecting, a lot of nefarious activity to come up.
What could go wrong in a paving company? Lots of employee issues.
There could be employee issues. There could also be environmental issues that arise. And then there are also, given the nature of the labor, a lot of compliance matters that could surface if we were to use a stock purchase.
Got it. So the big one to you is the fact that most of these are going to be asset sales.
Correct.
Hey, have you guys done any stock sales? Is that a possibility?
We strongly try to avoid that structure, but when we have acquired, call it a mini roll-up, and that is what whether it's a family office or the smaller private equity firm wants to do, we will undergo that. I think the thing for sellers to note if they want a stock purchase is that generally that requires reps and warranty insurance.
We've done a couple shows on that. And I don't know what the revenue number is, but generally maybe 5 million in revenue, 10 million in revenue before it becomes feasible to buy reps and warranties insurance.
And that depends on the industry. We typically don't use it until we get north of 75 to 100 million. And I would just tell sellers before you go down that path of wanting it, sit through a call, because those calls are fairly brutal.
It's very complex
and very long.
Lots of exceptions, and better get your attorney involved.
Yeah, absolutely.
But in certain circumstances, I think it's definitely worth it for sellers. A seller who wants to get out, you got to do a stock deal. Maybe for some reason there's contracts that need to transfer. You don't have a choice. The buyer's worried. Hey, pay for reps and warranties insurance so you can sleep at night.
And our industry is unique, especially within our space, that our contracts are generally not long-term. For us to do a parking lot at, say, a Publix or a Walmart is a 4-week turnaround. So we typically don't have those 1-2 year contracts where a stock sale is going to help us mitigate having those novate over to the acquirer.
What's novation for those that don't know?
Yeah, novation is just where the contract would, instead of going to the original entity, would go to the new entity in the post-acquisition world.
What's that process like for novation? Anything a seller would need to know?
It would depend on the contract. So you would want to work with your lawyer to look at the contracts. Some contracts are not assignable. You cannot novate them. So what you would have to do is go to your customer or your vendor and say, hey, I'm going through an acquisition. I just want to make sure that this contract is going to be valid. We're going to point you to a new corporate identification number, a new AP or AR point of contact going forward. But if there is that type of clause where it is available, then what you would want to do is just make sure that all of the data points and contact points are updated in the post-close world.
What other deal structure related issues are there?
I think that what I will typically see is a seller has a number just in their head, right? They want the valuation to be X amount. I can't justify that based on their current EBITDA profile, but if they want to bank on themselves, then we will insert an earnout to say, hey, if you're willing to bet on yourself, then we will make up, as much of that delta as we can, but it's going to be dependent on, 2 or 3 factors, and one of them usually being financial performance of the business. That is where I see a lot of kind of extraneous deal mechanics come into place. And sometimes it's a 1-year earnout. I've seen 2-year earnouts where, there was that delta that they thought, hey, my growth trajectory last year is the new norm. I'll prove it out to you over the next 2 years.
How do you structure an earnout if there's some integration with the parent company, with the platform?
So the structures that we have in place, and I think it's probably more, we're not integrating everyone into, hey, you're going to be Pave America X City, right? We leave the local brand and name intact. And we also we put them on their own instance of NetSuite. So we're able to monitor and track their performance by legal entity. So it's really not that difficult because we can just pull up their instance of NetSuite, see what their revenue was, see what their EBITDA was, and then that would dictate whether or not they received their earnout.
Each bolt-on is a separate entity?
It's not always a separate entity, but we are able to track them separately in NetSuite.
Got it. Okay. What if there's like cross-sell opportunities there? How is that treated for the earnout? I know that's a common question sellers ask.
Yeah. So we encourage it. We like to self-perform. So if there is the opportunity for, say, a company in Denver to sell work to a company in Texas. There would be a referral that is credited to the Denver company so that they are receiving some credit for that work that is sold to the platform. And I would say that most of the work that is cross-sold is not generally material enough to where it's going to either trip the earnout clause or not. What we do with the employment agreements that a seller will sign when they become a president of their organization and the platform is we'll build in a mechanism for their bonus. And part of the bonus may include cross-selling goals, and we're able to track that through our accounting system.
How much of the value that your company will create as a PE firm do you think will come from revenue synergies versus multiple expansion?
I think that's a great question. And it's something that we're evaluating right now. I think that it's a bit of both. I do think that there's a lot more right now with multiple expansion just because we were the first entrant into this space. And so, that's a long runway for the bolt-on multiples to catch up to what we were purchased for and what we would trade for if we were to go to market. But I do think that as we move across the US and become truly a coast-to-coast operation, the ability for us to sell work internally to other businesses as opposed to subbing it out where we're only getting a small piece of the pie is definitely an important part of the growth story of the company overall.
If we go back to earnouts there, what's your take on earnouts? How in love with earnouts are you?
I don't like them because for someone that's sitting in my role, so when I started in 2023, within 12 months, we'd acquired 14 entities. So I'm very busy sourcing, negotiating, and dealing with the first 30 to 60 days of integration to make sure that things are brought onto the systems where we do bring them onto our platform. Dealing with an earnout a year later is sometimes, it can be just kind of a headache, right? Also, when you're a private equity firm or when you're private equity backed, let's say we were to sell while those earnouts are still being accrued, they're treated as debt, right? And so for us, if we were to talk to potential buyers, then that's debt that we have to account for the business.
How are you guys sourcing your deals, by the way? That's a lot of deals. Congratulations. What's your secret?
What I have found is that the best source of targets are the presidents within our platform. And they know this because they are constantly subbing out work. We do have a national accounts division, so they are working with contractors all across the United States. So it's really easy to get names. And then as you're having those conversations and you go out to those places, something I didn't do before this job was I always look to see whose names are on the trucks in parking lots when they're doing repair work. And it's easy to find them and easy to have those phone calls. And also, I would say that because there's more PE activity in the space, I'm getting a lot more inbounds than I did, say, a year ago from brokers and bankers that are taking these companies to market. But I'd say the organic sourcing has definitely been our bread and butter.
What's an equity rollover and how does that work?
So when you get a purchase price valuation, you get your proceeds. What we allow you to do is take some of those proceeds pre-tax and put them into the platform, which means essentially you're on the cap table, which is the list of owners in the entity. So you have ownership in the business. Now, we do not require any of our sellers to roll forward money, but we are very forthcoming with, hey, private markets outperform public markets. There's the opportunity for you to get 2x based on what we've seen historically. And when we sell, they would be able to take those chips off the table if they want.
Do you want them to roll?
We like them to roll forward because given that the presidents are all sort of running like mini fiefdoms, and that sounds like we're not integrated, and we are from a back office standpoint, but we want them all to be incentivized to refer work to each other, to work with their partners. If they have equipment that is available and somebody else needs it, we would like for them to be able to share that equipment. And if everybody owns at the top level, at the Pave America level, there's a lot more incentives for them to do that so that the whole platform performs, optimally financially.
What size roll do you like?
I'd say the average roll is between 15 and 25%. I've seen as low as 5%. I've seen as high where we have to get approval where someone wanted to roll forward 35% into the platform. And I think it also varies based on the purchase price, right? So if it's a smaller deal, they're probably less apt to roll forward significant funds. Whereas if it's, a very big headline purchase price, they've already got a lot of chips off the table. So they're willing to put, some more into the platform itself.
What should they expect in terms of how the consideration is paid, how the purchase price is paid? Cash down, earnouts, seller note, escrow holdback, and so forth?
We do all of our transactions cash-free, debt-free. So any cash in the business would go to the seller. We wire all funds the day of close. So that would all be in their bank account once the wires are cleared. We do typically use holdbacks for general reps and warranties.
Environmental, if there's successor liability.
Exactly. Anything like that pops up. It's generally, I'd say, between 2 and 5% of the purchase price.
That's it. It's kind of low.
It is. We do a lot of diligence on this beforehand. So we do spend a lot of money up front. And then we also do an escrow for net working capital just to make sure that, there's enough cash in the business for it to be able to operate. And then we'll do a true up 90 days later. And if anything's in excess, then that would be released to the seller. And if there's a shortfall, then we would keep what we need to make sure there's sufficient cash in the business.
Well, let's take another quick break. And then when we come back, we'll talk about those two very exciting topics, due diligence and, unfortunately, net working capital. This is Jacob, your host, and thanks for listening to the show. If you'd like a free copy of one of my books on selling a business, you can send an email to podcast@morganandwestfield.com. And we're giving away 2 books. The first is The Art of the Exit, The Complete Guide to Selling Your Business. It's written for businesses with 1 to 10 million per year in revenue. And the second book is Acquired, The Art of Selling a Business with 10 to 100 million in revenue. And again, if you'd like a free copy of either of those books, you can send an email to podcast@morganandwestfield.com. And now back to today's show. Welcome back to M&A Talk with Brandon Blewett. So due diligence, I'm assuming that takes you what, 2 or 3 days?
Yeah, exactly. 2 or 3 days and then we're completely done.
Then you cut the check, right?
Right. No, I always tell sellers, that there's generally a lot of excitement when you sign the LOI, and we're very transparent. It's actually in our what to expect from now until close document that it's a bit like going through a physical exam, that we're going to poke, we're going to prod, and we might even point out some things that are uncomfortable to hear. But the reason that we're doing that is so that we know what we need to fix post-close from an integration standpoint, and that we know, hey, here's some things that are going to be of concern to our lenders. How do we work through telling that story in a way that's satisfactory so we can still get to the closing table?
How is your financing handled? Is that deal by deal, or do you have some sort of credit facility? How does that work on your side?
We do have a credit facility.
So do you need an approval for a smaller transaction, or you guys cut the check, you're good, and no financing?
So what's really interesting is that for some of the, what I call tuck-ins, where headline purchase price is between, call it 1 and 3 million, a lot of times what we do is, instead of using EBITDA as the valuation anchor, we'll use the fair market value of their assets and equipment as the anchor. And so what we can do then is
collateral-based lending.
Exactly. And so we can even use Capteris, which is a CapEx, financier, because essentially all we're doing is buying the equipment from an entity and then just hiring the employees.
What are these companies worth? What is a typical, say, a deal for 20 million? What's the revenue, EBITDA, equipment? What might it look like at a high level?
So for a 20 million transaction, I would assume that business is at roughly 4 million in EBITDA to get, a 5 handle. And I would expect that the revenue on a $4 million EBITDA business is probably in that $42 to $50 million range, maybe, or $35 to $40 million range to generate that type of multiple.
10% EBITDA margin, selling it at 5x.
Right.
How much in assets?
That varies depending on if it's, because all of the equipment has, obviously very different valuations. So if somebody's heavy on milling and paving, they're going to have a lot more expensive equipment. Whereas if we buy a company that they're more in striping and patchwork, that's going to be a relatively asset-light business. And it's going to be more of a volume game for them to get to the revenue and EBITDA numbers. I'd say that We do a fair market value assessment of the equipment through Rouse. They come on site and kind of spot check. But what we typically will request is their annual CapEx spend. And then as much as we can understand how much of this is spent on growth CapEx versus how much of this is on repair and maintenance for your existing fleet.
How do you do that?
Sit down with the owners and just ask. It's always a messy process. And a lot of these, just diligence in general, outside of the quality of earnings, QV, the legal diligence and tax diligence, we really try to be very hands-on. I go on site, work with them. We've translated the M&A playbook into language that is largely accessible. And I always tell them, look, I understand that some of these are going to be no or not available. That is fine. Let's go through these quickly. And then what's not available, we'll just figure that out on the back end. So it's not as scary of a process, and they're not just staring at this list that's, hundreds of questions.
I mean, listeners, you're going to get a big, long due diligence list. Don't freak out. Just go down the list. And if you don't have it, just mark NA. That's all. Because why do you ask for that stuff if you think they're not going to have it? Just so listeners know.
We have to ask it, right? And I will always put context and clarity around any questions. And that's why I do it in person, is that way they're not just reading these questions. They don't understand what it means. I can say, look, this is what we're asking. You probably don't have it. If you don't, it's okay. We mark it off and we keep going. But for us to get approval from our private equity sponsor and from our lenders, we have to ask all these questions and make sure that we've done the homework ourselves. And if there are risks, that we have a plan to mitigate that post-close.
You have a lot of stakeholders you have to answer to.
We do.
Brandon, what's the biggest mistake that you see sellers make in diligence?
I think the biggest mistake that I see is they try to tackle everything without asking questions, and they experience paralysis by analysis.
What do you mean by tackle everything?
They think that they need to go through every single question within the first day and have an answer on their own without asking.
And prepare a business plan and prepare all sorts of documents requesting they don't exist, and scrambling around. We don't have an HR policy. Go put one together. They need it.
Right. Say, a safety handbook. Like if you don't have one, that's fine. We have one. I just need to make sure
just
that
want to know
ask.
if you have one. Right.
Exactly.
Make sure it doesn't say anything crazy in it.
Right.
What other mistakes do they commonly make?
I think probably the most costly mistake I see sellers make, and maybe this is specific to this industry, but their circles of trust are very small, and they will also extend that to choosing legal counsel. They pick a bankruptcy or divorce lawyer, and that creates a lot of issues because I can't tell you how many times it's come down to the wire with the disclosure schedules, and the seller's counsel has never put disclosure schedules together. Now, on our end, we anticipate this now, so we start to work with sellers to say, hey, these are what they are. Here's some folder structures. Start putting these things together. But I think getting competent deal counsel is paramount if you want to sell your business, because the lawyer can make or break the deal. Because if we can't get our lawyers comfortable with, what your lawyers are sending across, then you eventually come to an impasse.
Would you define competent as experienced, and you would define experienced as an attorney that does at least a third of their practice as M&A?
Right. You don't have to go hire some Wall Street, Kirkland Ellis, Sullivan Cromwell deal lawyer.
They can be in Topeka, Kansas, as long as that's their specialty.
Right. Exactly. Just like you wouldn't hire a divorce lawyer to draft your trust and estates, you should make sure that there is somebody that has experience selling businesses and understands, deal mechanics and all of these schedules that come with the purchase agreement, as well as the diligence requests that you're going to get.
What other common mistakes made in diligence?
During diligence, I think that maybe it's similar, is where they've only hired a CPA to do their tax returns. And so they are not necessarily financially sophisticated, and their CPA only knows the basics. So as we go through financial diligence and have follow-up questions, they're unable to answer the questions. And what that does is it just muddies the valuation process. And so what they present up front, and we say, okay, this is the basis of our valuation, and they have that purchase price in their head. Well, if we go through the accounting, we see that they've been making a lot of errors. Their CPA maybe hasn't caught that. All of a sudden, EBITDA starts to slide off of a cliff, and the valuation starts to look less attractive to them. I don't like to retrade. Nobody likes that process. And so I think having a good CPA and a strong accountant internally is something that every seller should look at having.
Do you like when they do a Q of E pre-sale?
Yeah, to me, we're always going to do a buy side QV, right? I do think that if someone has a competent lawyer, a competent broker or banker, and they have a sell side QV, obviously that is going to expedite the process because, assuming that they used a reputable firm to conduct the QV, there's a lot of, you're validating, right? Instead of going on an archaeological dig, which makes things much quicker.
Let's talk about net working capital. And I'll have a link to a very exciting 5-page article I wrote on that. So for the listeners, generally depends on your definition, but accounts receivable plus inventory minus accounts payable, approximately current assets minus current liabilities. That's included in the purchase price. By the way, what is your specific definition for net working capital for paving companies?
That what you just said that's the formula that we use.
What kind of bombs do you see here?
So for us, the biggest bomb is a lot of our work is very seasonal. So your net working capital is generally going to be much higher when you are busy, and it's going to be much lower when you've laid off your workforce and you don't have as much revenue coming in the door. And depending on when the deal closes, so we typically like to close in the winter months because then we're not disrupting business operations. So where we get into, I wouldn't say arguments, is that a lot of times the sellers want to set their peg based on the close date. And what we like to do is use a blended average so that we really understand over the course of the year what is the actual net working capital that we need to have in that business. And we're never looking to, pull one over the seller so that we can keep that cash. But being a very seasonal business,
you need that at some point.
Exactly.
How do you do a blended average on that?
It depends on the deal, because if a company is in, say, Florida or they're in Houston, seasonality is going to come into effect a little bit less. So, maybe we do the last 6 months, depending on the transaction date. We've done 12 months before, and we've also done 3 months. So it really is geographic specific, and then also based on the time of the year that we close.
What about purchase agreement? What issues are there in the purchase agreement that you'd like to discuss?
I think that for us, we are very purposefully down the middle of the fairway with our purchase agreements. And so there are some terms that are in there that are more advantageous to us that I know that I can negotiate with. And there are also terms where it's just a no-go, right? And so, I think because we generally, the initial feedback we get from sellers counsel is, this is a lot fairer than I was expecting to come back. So I think taking that approach, we generally don't get a lot of, really strong pushback. The initial conversations will be around, tax matters, if they want it stock versus asset. We find ways to true up so that we can have an asset purchase. But I really think that the biggest thing that I see with the purchase agreement is the disclosure schedules. I've had several sellers ask me, do we really need those, or can I close over them? And I'm like, no, it's sort of a very important part. So I think those are the two things that come up the most.
What kind of issues do you see in those disclosures?
A lot of times it's what you'll have is sometimes we'll get the full due diligence report, and then how they write about a matter in the disclosure schedule doesn't sync up with what diligence uncovered. And so we're having to go back and forth to make sure that, hey, this is what you said it was. Or what I've seen is last minute, someone decides, oh my gosh, I had all these contracts that I didn't realize I hadn't uploaded and provided to them. And some of them may be completed, but if you let us know and list all of these contracts and disclosure schedules, we have to go through and vet every single one to make sure that all the terms have been satisfactorily met, et cetera, before we can, close out that matter. And so it's usually things like that, oh, this got included. Now we need to have a discussion or have our lawyers, vet and clear it. That just adds time to the overall process.
How do you handle work in progress? It's just a component of net working capital.
Yeah, yeah, that's typically how we've done it. And then, like I said, a lot of times what we try to do is close deals in the winter months where we're not working, so it's clean.
What's the toughest part about doing all this for you?
The toughest part is that there's so many deals that I want to do and there's not enough time. The reason that that's tough is because there are players that are starting to enter the market, and so there's a lot of sellers that I really like, but there's only 3 of us on my team. And so we're only able to churn through so much deal activity at a time. And there's been some deals that we've lost out on simply due to the fact that I couldn't act now and there was another buyer ready to go.
So there's 3 of you guys at the corporate development team for Pave America, right?
I'm the head of corp dev, and then I have 3 that work for me.
Does the PE firm help you at all with the acquisitions, or no? Is it your primary responsibility?
So when we started, they helped, but now we run completely independently. Obviously, we have to give them investment committee decks, and there's a lot of follow-up questions where they deal with a lot of the lenders. So on that diligence front, they're handling a lot of those questions. But as far as sourcing, running third-party diligence and internal diligence, that's all the Pave America team.
What's on the buy side for you? What's the toughest part of the whole sale process?
I think the toughest part is when owners start to get cold feet throughout the process. And it's very understandable, right? Most of these business owners have never had to answer to anyone. Me, on the flip side, like, I started off in large professional services firms. So, answering to the man, in quotes, is something that I've had to do for my entire career. I understand that part. And so a lot of times I laugh, in consulting, I would get calls at 2 or 3 o'clock in the morning, and it was, hey, we need to turn around this deliverable, first thing in the morning. Now when I get calls at that time of night, it's a seller that's freaking out, and it's my job to talk them off the ledge to make sure that they realize it's going to be okay. You've talked to other presidents, other people have sold, they're not in shackles. They enjoy what they're doing, and coaching them to get them rowing back to the closing table.
And Brandon, as we wrap up the show here, it's been a great conversation. What's your advice to sellers out there that are thinking about selling their company?
I would say that I would start thinking about the metrics and KPIs. And I know those are 2, we could probably delve into that, but I would start thinking about the metrics to make a business attractive to sell, and organize your business and your operations according to that by a certain date, right? So think about how long it's going to take to get, EBITDA to a certain place, to get customer concentration to a certain level that's palatable for sponsors. And then once you're at that point, engage with competent advisors, both, sell side brokers and bankers and lawyers that are going to make the process as painless as it can possibly be.
There you go. The basics of roll-ups with Brandon Blewett with Pave America. Brandon, thanks again for joining us on the show, and hopefully you'll join us in the future.
Thanks for having me.
And we'll have Brandon's contact information and the show notes for the listeners if you have a paving company you'd like to sell. And I'm sure Brandon would be happy to talk to you. And Brandon, thanks again for joining us.
M&A Talk is brought to you by Morgan & Westfield, a nationwide leader in mergers and acquisitions for small to mid-market companies. If you've enjoyed this show, don't forget to subscribe and leave a review. Learn more at morganandwestfield.com. While we take reasonable care to select recognized experts for our podcast, please note that each podcast presents the independent opinions of such experts only, and not of Morgan & Westfield. We make no warranty, guarantee, or representation as to the accuracy or sufficiency of the information provided. Any reliance on the podcast information is at your own risk. The podcast is for general information only and cannot be considered legal or professional advice.